All right. Matt, the mortgage guy. In today's video, I want to talk about something we haven't talked about in a long time, lender credit. It may or may not be as widely used in 2021, but there's a lot of misconceptions. There's a lot of things that people don't understand. I know that because I get questions on it every single day. Before I jump into it, if you like straightforward mortgage content as it relates to real estate, the real estate market, from a mortgage professional who's working in mortgage day in and day out, closing hundreds of transactions per year, talking to hundreds of real estate agents per year, I can give you some knowledge in the weeds, in the streets, finger on the pulse, whatever you want to call it. And I share that here 3 times a week. I do a YouTube live every Monday at 6 p.m. Like, comment, subscribe, share the videos. Do whatever you can to help. I appreciate it. Let's jump into it. So lender credit is something that I feel like probably doesn't get utilized as much in 2021. I'll give some reasons behind that, but first I want to dispel what I would call, misconceptions, probably a little bit of tricky marketing, or maybe the way lenders word things that lead you to believe lender credit is something it's not, right? Let's get this out of the way. Lender credit is not a coupon. It's not something you get because you're a special client. It's not something you get because somebody likes you more than the next person. It's not something you get because your realtor's a really great person and connected you with their preferred lender. I'm sorry if you've heard that, if somebody's used that as a marketing ploy. It's just not true. Lender credit is simply a credit given from the lender because you took a slightly above market rate. That's really all it is. If you haven't heard this before, or I haven't explained it to you in a past video, rates are simply based on your scenario: credit score, down payment, loan type, and by loan type, I don't only mean conventional FHA, VA. I also mean, is it a primary residence? Is it investment property? Is it a second home? You're going to get a whole rate sheet. And so it's not, hey, what do I qualify for? What's my rate? It's more of, here's a rate sheet. Here's a few options for you. Generally, it steers toward one that makes more sense based on math. But you might, for your specific scenario, and I'm looking at a rate sheet right now, have a rate sheet that starts, this is a 30-year fixed, up at 2%, goes all the way to 3.875. So you could literally have any of those rates, 2%, 2.125, 2.25, 2.375, all the way up to 3.875. And here's how it works. If you've heard this before, I apologize if I'm repeating stuff, but on this big long rate sheet, where you've got 17 different rates to choose from, 3.125, we'll use that for this scenario, might be the par rate. It doesn't cost you anything for that rate. And as you go lower in interest rate, you're going to pay. That's often referred to as points. As you go higher in interest rate, you're going to get a credit, a rebate, lender credit. So that's all it is. If I gave you a 3.25 or a 3.375, or better phrased, if you chose that higher interest rate to get a credit, you would get a lender credit, right? It's not something I gave you because I like you, and it's not something that I'm able to say this person gets it, this person doesn't. If you choose the higher interest rate, you can get a lender credit. In this example, 3.25 might provide a $3,500 credit. 3.375 might have a $6,500 credit attached to it. You would have to decide if you prefer the lower rate and the lower payment, or lower money cash to close. This comes into play when you're getting strategic about it. You're saying, you know what? I've got 5% plus closing costs, but I'm really tight. I don't want to spend every single last dime I got. Do I want to take 3.375, keep $6,500 in my pocket, knowing that my payment is going to be $76 more than it would be if I took 3.125? Or on the reverse, do I want to pay Let's call $6,000 the cost for 2.875. Do I want to pay an extra $6,000 today to lower my payment from 3.125 to 2.875? It's going to be $76 cheaper per month. You know what I do in these scenarios when I'm talking to people? I pull this thing out. And I say, you're saving $78 a month, but it's costing you $6,000. That's roughly a 79-month break even. I'm not a big fan of a 79-month break even, where you're, one, banking that you're going to be there 7+ years, two, banking on those dollars in 7 years being worth anywhere near what they're worth today. In 2021, I'm not betting against inflation because I think you're going to lose that bet. But anyhow, this is how lender credit works. Don't let the smooth taste fool you when somebody says, I'm going to hook you up with some lender credit. They're hooking you up with a higher interest rate. You might want that. And where this is more commonly used, to be honest, is when you're getting a loan, you know you're going to be in for the short term. Let's take the FHA loan, for example. Rates on the FHA loan are absolutely amazing. You might be able to get a 30-year fixed at 2.375 and not pay any points. I might be able to give you a 2.75 and give you $7,000 in credit. If you knew you were going to increase your credit score, you were going to pay some extra money down on this and remove mortgage insurance within the next 2 to 3 years, remove it or lower it, you would gladly take today's lender credit, pay an extra $70, $80, $100 a month, knowing you're going to refinance out of that FHA loan well before whatever break-even period. Because the break-even period is the same for getting a rebate. You're getting $6,500 extra in your pocket today. Sure, you're paying an extra $76 per month, but if you go $6,500 divided by 76, 85-month break-even. You're not in that loan for 7 years. I'm going to give you a hot tip right now. Hardly anybody is in the same loan in 7 years. Sell, refinance, cash out, something. The average life of a loan is 3 to 5 years. And so people paying up front to get a lower interest rate, I'll tell you what that is. That is water cooler money right there. They want to sit around the water cooler and tell their friends, oh yeah, I got a 2.375 on my mortgage, 30-year fixed. Yep, got the hookup. Little do they know, they got bamboozled because they paid 2.8 points. They paid $14,622 to save the little bit they're going to save, buying it down from 2.875 to 2.375. It likely wasn't worth it, but I digress. That's lender credit. That's how it works. It's something you get in return for taking a higher interest rate. It's not a present. It's not a gift. Some builders, lenders will offer it. And in that case, maybe it is a true incentive, right? But a lot of times the rates are higher, so maybe it's a blend of true incentive and lender credit for taking a higher rate. Whatever the case, know what you're getting into. Don't think that people are just, handing out $100 bills for free out of the kindness of their hearts. More than likely, it's because you're taking a higher interest rate, which, like I said, in some cases might be the best bet. So that's that. If you have any questions at all, if me and my team can help, we are more than happy to. Please feel free to reach out to us. Go to greatmortgagebroker.com, fill out that quick form. We'll connect you with somebody who's local to you who can help you out, purchase a new house, purchase an investment property, refinance, whatever your needs. Greatmortgagebroker.com. Please reach out. We're happy to help. Until next time, we gonna see.